Hello and welcome to Real Day Trading. I should really change that to Real Trading. We're going to rebrand that because we don't just day trade, obviously. We swing trade. So I got to figure that out. Speaking of rebranding, someone copied my freaking Twitter account. Why? Why would anyone do that? I have no idea, but a few hours ago, one popped up. They just brilliantly replaced the lowercase I and ing from trading with an L. And they opened up a page that looked exactly like mine, and I guess they're reaching out to people. I was going to say, if someone reaches out to you and they're an ass, it's not me, but there's a good chance it could be. So look at the identifier. If it's an LNG instead of an ING, you know it's not me. The person's already been reported. But, I mean, who has the time to do something like that? It just boggles my mind. Let's get to SPY. Well, we can draw all the damn lines we want here. We drew really nice lines up here, right? Over here. Great. SPY didn't give a shit. Blew right through it. So why? What's going on? It's not the Fed. If it was the Fed, we're much more dovish in our anticipation of what the Fed's going to do now than we were a month ago. In fact, if we were just looking at what the Fed is doing or what we anticipate them to do in March, well, this would have just kept going up. We'd be over 460 right now. Very bullish trend. But no, this is Ukraine. And of course, you'd have to ask, what the hell does a conflict between Russia and Ukraine have to do with the market? Why? I mean, war is generally good for the economy. So is this like just a temporary dip and you buy the dip and you go? Here's the issue. It's energy prices. This war specifically affects oil and gas pricing. It will go up unless some alternative deal will be struck. So if you see an announcement that we've come to terms with another deal with Iran, for example, you'll see the market jump up. Any alternative to keep the energy prices down. Why? Because the higher the energy prices doesn't just mean you're paying more for gas, even though it will, but it means that manufacturer costs go way up. They use energy. And if their costs go up, well, they still need to make a profit. They're going to fire people or raise their prices. And when that combines with inflation and other house of cards like issues we have, it inches us closer to the mystical recession. Now, I don't know if there's like some sort of monitor, like DEFCON thing, and it's like, now we're officially in recession. It's more like a bunch of people who are economists come out and say, yep, we're in a recession now. We passed this level by this percentage point. And then Washington Post, New York Times, so it's, American recession. And then before you know it, you start telling, we're in a recession right now, right? And everyone's saying recession, and now we're in a recession. You can market the idea of a recession. Either way, investors don't like recession. And so there's fear here. How much of that is baked in? Hard to tell, right? How long's the recession? What's the odds that it'll happen to begin with? How bad will it be? And since all those are unknowns, buyers are boycotting. Now, if there's a sign that energy prices are not going to be affected as badly, or we're going to get some alternative to that sources of oil and gas, then you'll see those fears alleviate. Market will go back up. And what will be the sign of a bounce like that? Can happen tomorrow. The sign would be a huge gap down, and I'm talking way down here, like it overshoots the price that people are like, oh, I'll buy at that price. I don't care what's going on. And all of a sudden, let's say you gap down to like 410 right here, 411, and then immediately reverses. Green bar, green bar, green bar, and it does not stop. This is where you want to go long futures. It'll just keep going. And you will end the day with a really nice bullish hammer on the daily chart. So what do you do if that happens? Right? Now you got it, right? You got SPY, rebounded, bullish hammer. Things are starting to look better. What do? Rush out and buy calls on everything? Throw a dart at tech and buy a call on it? Well, maybe you could, probably. Sure. That's one way. There are some other ways you could take advantage of that situation, though. So, let's take a look here. As I said, I'm not going to go into the challenge at the moment until we figure out, is NVIDIA going to go up or not? If NVIDIA goes up, well, then we're back in the game. If NVIDIA doesn't, well, then we got to figure out what to do and revamp. But for the moment, let's pretend SPY jumps. Yay, everyone's happy. So now you got your bullish hammer, and futures are up, things are looking good for the next day, and it looks like we're going into Friday with a strong bullish trend. How do you take advantage of that? So I'm going to give an example here. I'll use Google, but you can do this on lower price stocks. You can do it on Home Depot. You can even go all the way down and do it on a stock like Marvel or Pfizer, right? It all depends on how much you're going to get for the premium, and I'll show you. The first thing you want to do is you're going to buy a leap call. Now here on Google, this is going to be kind of priced out of one's range. So you know what? Because that's going to cost around $60,000 or some odd to do it. Let's go with, I don't know, Home Depot, just for the hell of it, right? Okay. Home Depot. Let's say now you're going to go all the way out to about a year out. So January 23rd. They don't have March. January 2023. They don't have March 2023, unfortunately. So let's go with January. And you want to go to around, I don't know, 0.75, somewhere around there. But you're right here. So 250 calls. We're at 308, so you're $58 in the money. And on the 250 calls, those are going to cost you roughly to buy $6,900. $6,900 to buy those calls. But you're not just going to buy those calls. Every single week, let's start with next week, you're going to sell a call against it. And in this case here, you want calls that are around the 0.10, 10%. Delta. So let's look here at the 330s, right? So you're going to sell the 330s. Okay. So when you do that, now this whole thing, let's say it cost you, well, it's going to cost you, let's say $6,800, somewhere around there. You're going to get $80 a week in revenue off of these every single Home Depot contract. Well, that is around, let's round it up a minute, $350 a month. You'll get $350 a month off selling these calls. So if you did this for 6 months while holding the leap call, you would get around $1,800. $1,800 in revenue for over 6 months of just selling Home Depot out of the money calls. Now, you can't do this unless you own that leap call. Why? Because you don't want to sell a call on Home Depot naked here. You don't want to sell the 330 calls, and then all of a sudden Home Depot jumps up $40 in the week or $50 in the week, and now Home Depot's at $358. And you're stuck $28 a share, over 100 shares. Well, that sucks. Now you're $2,800 in the hole on that call because you have nothing to cover it with. It's a covered call and you have nothing to cover it. So that's what the leap does. If Home Depot goes past this, activates your leap call, you're buying Home Depot at $250, turning around and selling them here at $330, you're making $80 a share. Even though it went up to, like, let's say $350, doesn't matter, you're still making your $80 a share there. Right? And you paid $6,900 on it, so you made $1,100 if that happens. If it went up to 350, for example. Because don't forget, when the price of the stock goes up, the value of your leap call will go up. Now you own that leap call. Every week you're just selling these out of the money calls against it. And then they expire worthless, and the next week you do the same thing and the same thing. So you just keep collecting the money. Now, if you look back over here again at the January one, this is a 250 call, and Home Depot is at 308. That's $58. That means if you're buying this for $6,900 or $69, you're paying $11 or $1,100 in premium. In other words, if this call was worth $58 and it's a 250 call, it would be exactly at parity. You buy it at $58 or $5,800, and then the next day you can just exercise it if you want, and you can buy 100 shares of Home Depot at $250, and then turn around and sell them at $308 and make your $58 back, break even, except you'd be paying commission, right? So here you're paying that extra $1,100. Well, we already said if you're making $80 a week on the Home Depot calls, right? And let's say you're making $350 a month, or 300, if you're making $300 a month, after 6 months you have $1,800, and this was $1,100 in premium. Well, you've already paid for the leap call, and you're $700 in profit at that point. Now you have a leap call pretty much free and clear. And if Home Depot continued to go up, because you're in a bullish market, let's say, well, now you have a leap call that's much more valuable than $6,800, $6,900. That's called a fig leaf. It's a poor man's covered call, right? You could put them on Google. It'll cost you more. You could put them on cheaper stocks. But the idea being you find stocks that you feel are going to go up in the long term, and that you could sell calls against it. Now, there's some fundamental analysis that goes in here. You do want to take a look at the daily charts of these stocks. So, for example, if we were looking at a stock like Home Depot here, you can see this huge drop. You would want to make sure that that drop is reversing before you did that type of call on it. You do not want to use the strategies to just predict bottoms, right? You don't want to go and say, oh, okay, Google seems cheap now, it's going to turn around. You make sure it turns around, right? And it's not that difficult to do. You just draw a downward sloping trend line like this here, and then put an alert. Done. When it crosses that trend line, which right here is around 26.75, okay, now Google's back in a bullish trend. It's now violated its downward sloping trend line, and if the market also looks strong, go ahead and buy that's where you do the fig leaves. Now, a stock like Google, your long leap call is going to cost, I don't know, $65,000, and you'll be able to revenue around $700 to $900 a week. Well, all right, then after a month, you're going to make around $3,200 a month. You'll make around, I don't know, $18,000 to $20,000 in 6 months. Doesn't pay for the leap call, but it pays for all of the premium and then some. So that's the idea behind it. So that's one thing you can do if the market starts jumping up. The next thing I recommend you do are called debit spreads. We do those a lot. I recommend you use them. But the best thing you can do is, for example, I'll show you here. This is in Option Stalker, but you're going to go to sector, right? And this is if the market is jumping up. Let's say tomorrow bottoms out and then bam, springs up, bullish hammer. Now sitting here on Friday, and it looks like we're in a good bullish trend. You want to see what sectors are strongest, right? Let's say here, this is the tech sector, right? So let's say this sector here. And then you want to see which of these, if any, are, well, if it's strongest, they all would be, but which of these are the strongest within that sector, right? So let's say it's, Apple or Microsoft, any of those, Cisco, any of those. Those are the ones you want to do potentially a call debit spread on. And it would expire at the end of the week because these things will be jumping up quickly. If you do decide to go with straight calls, for the love of God, please stop with the out of the money bullshit calls. They do not work. Let me say it again. They do not work. They are moronic. You are literally paying money for the right to buy something at a price that is more expensive than it currently is. You would not do that anywhere else in the world. You would laugh at a person who suggested a deal like that to you. Can you imagine? You can go into a store and you're going to buy, I don't know, milk. Everyone always buys milk, right? And so it's like, oh, it's $4 a gallon. But if you pay me 50 cents right now, well, you know what? I'll give you the right to buy this milk next week for $5 a gallon. Well, but it's $4 a gallon now. I know. But it might go up. What if it's at $8 a gallon next week? And you will be the lucky holder of a contract that says you can buy it for $5. So pay me 50 cents and you can buy your damn milk at $5 next week, even though it's at $4 now. That's the stupidest idea. Buy in the money calls that do not have much premium. For example, Apple. Right now, Apple, if the market was going up, does not have much premium attached to it. You can look and see here the midpoint even, and this is because it's after hours, but for the 150 calls is $9.85. Now, again, it's after hours. That would never happen because the actual price of the stock is $160. Remember, add the price of the option to the price of to the strike price, and then subtract it from the stock price. Well, here you're gonna have $159 minus, 160. You're actually making money the moment you buy it. Obviously, if this option was at $10, it would be a perfect parity. 150 strike, stock at 160, bought it at $10. Okay, I have the right to buy Apple at 150. I could turn around and sell it for 160, get $10 back. Well, I broke even on the trade, except it was stupid because I spent money on commission, right? So you want it as close to that $10 as possible. Right now, Apple is running very close to parity, even though its implied volatility is actually kind of high. That's not a bad deal on when it comes to options. The only thing missing right now for Apple is obviously Apple is a stock that is going to go over its 100-day moving average, and that's what you want. You want it over the 100-day moving average here, ideally. But you do have a decent hammer here, and there was some relative strength in the stock. You have increasing volume right here as well. So, compared to other tech, like here is Microsoft. This one here is actually below its 200-day moving average. Right? So this has a ways to go. So I would look for stocks like that, and if you're going to buy calls, you want to buy them not only in the money, but you want to buy them at least at least 1 week out. So if, on Friday you're buying a call on Apple, go at least to March 4th, but because it's Friday, March 11th. And then finally, 0.65 delta or higher. So right here, this would be, for example, the call you'd want to get on Apple. Right here, the 155s. Do they cost more? Yes. Could you get, I don't know, 8 of the 170 calls for one of the 155 calls? Again, yes. But don't forget, on the 155 calls, $5 of that money is already baked in to the price from the stock. So you're really only paying, when you look at something like that, you got to look at it as, okay, this costs $8 for the 155 strike. I'm really only paying $3 for it because $5 of it is the price of the stock. So it's much lower, right? All right, so those are your potential options. Today, I had a couple of plays that made me a decent amount of money. Most of them were shorts, but there were some nice longs. For example, we can go and see Ice song now. I don't want to do it. I don't want to do it. Ice, Ice, baby. See, I did it. Ice. Let's go to Ice here. Ice actually did Ice. There we are. Okay. We got it at take a look here. I got Ice at 125.12. Okay. And I sold it at 126.12. So I bought it right around here. Sold it right up here, pretty much right at the top. I sold it, wow, 2 cents from the top, 26.14, or 26.12. I sold it at the top. I actually had my sell in, price point in at 26.12 and sold it right there. Could not have gone any better. So that one worked out pretty well. I didn't particularly love the daily chart here, even though it was well over the 200-day moving average at the time. I did like the strong momentum we were seeing against a weak market, right? Market was going down, ICE was going up. So I did like that. Another decent play that we did was, let's see here, BTU. That one in there, BTU. BTU, I bought at 1848, right around there. And then I sold it off right up around 19, right up here. Wound up getting a little bit more up here before it started dropping. But this was an energy stock, decent daily chart up here. It's a little bit stuck in consolidation and never really got rejected on this breakout. So I would watch it. The real money came in on the shorts today. Honestly, it just, we did a short of, let's see here, CMCSA. What a long ass name for a stock. I mean, look at that. This thing just drop, 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 drop. Shorted it around 45, somewhere down here and here. And then took around 50 cents up for it, around down here. You can look at the daily chart. Sucks. Really bearish. Bearish market. That was a no-brainer short. I took profit on, let's see here, Amazon. That one there, I originally set up as a hedge. And I went ahead and took the Amazon 3,000 puts, 3,000 strike puts for $99.35 and sold it right down over here towards the end made $7 a contract on that. It was a decent hedge. Amazon, Tesla, Google, but Amazon, Tesla mainly are really good stocks to use to hedge your portfolios if you're too bullish. Why? Because they move with the market generally and in an oversized manner. So if you do put debit spreads or anything like that, particularly if you do straight calls or puts, they certainly hedge your portfolio nicely. And then one of the better trades in a while, only because of the number of contracts I had on this, but was earlier in the day, I did a put debit spread on DE, because look at how bearish that is. Breaks down here, breaks through, and then continues to break through right there. And I did a 345, 340 for, I think it was a dollar. I want to say, let me see here. Let's see, DE, there it is, $1.73. And took pretty much 60% profit on that. That was a really no stress trade. Very bearish in a extremely bearish sector. Again, remember I showed you the sectors. So that was a kind of a no-brainer there. Okay. Well, tomorrow, I would be very careful on the shorts. Try to keep things to day trades. The indication that it is good to swing again is if you see that sudden reversal on SPY and the huge drop, opening down here and then popping back up. Do not trust the gap up tomorrow unless it is news related, right? Unless all of a sudden, the world comes together and sings Kumbaya and everybody's happy and fine and, oh, no invasion, yay. And we can go back to hating on Powell. Great. Then sure, things are bullish again. Then you start swinging again. But until then, keep it to day trades. And if you're not going to do that, then keep it to risk mitigated spreads. And if you're not going to do that, well, you need to step back and you know exactly at this point what you need to do. You need to do that. Read the damn Wiki. Good night, everyone.